Welcome back to Talk Tickers. If you are listening to this, you are looking for the signal in the noise. You want the no-nonsense professional earnings breakdown that respects your intelligence, your capital, and your time.
Right. We don't do fluff here. We do analysis.
Exactly. We do analysis. And today, we're doing a deep dive into a ticker that has absolutely set the energy and infrastructure world on fire this week. We're talking about TPL, Texas Pacific Land Corporation.
The ETF of the Permian, or at least that's what people used to call it. It was always sort of the safe way to play the basin without having to pick a specific driller.
Yeah, exactly.
Yeah.
But after this week, I think we have to retire that nickname. We have to call it something else entirely. Maybe, I don't know, the landlord of the singularity or something equally dramatic.
Yeah.
Because we just got the Q4 2025 numbers, and looking at the tape, the market has spoken loud and clear.
Yeah, they really did. The stock ripped 10.4% on the day of the print. Volume was super heavy, over 800,000 shares traded.
Which is nuts for them. This wasn't a sell the news event at all. This was a massive wake-up call for anyone who just hasn't been paying attention to what's happening under the hood here.
It was a total narrative confirmation. You look at a move like that, double digits on a company of this size, a company that usually trades like a boring royalty trust, and it tells you that the investor base is aggressively repricing the future cash flows.
Right. They aren't looking at last quarter's oil price anymore.
No, not at all. They are looking at next decade's power consumption. They are realizing this isn't just a land company anymore. It's a royalty infrastructure platform, but with this massive call option on AI and data centers attached to it.
And that is exactly what we are going to unpack for you today. We are breaking down the Q4 2025 results, which were solid, but we are really going to spend the bulk of our time on the real story here, which is the water, power, land flywheel.
Yeah, the flywheel is the whole thesis now.
It really is. So we're going to talk about the duck inventory and, no, for those listening, not the bird, the DUC. We're going to talk about this massive partnership with Bolt Energy, and we are going to get into a science project involving freeze desalination that might just be the most important thing happening in West Texas right now.
It's a fascinating quarter to dig into because it really bridges the gap between the old economy, digging stuff out of the ground, and the new economy, which is processing data. And TPL sits exactly at the intersection of those two worlds.
Okay, so let's start with the scorecard. The print itself. We saw the stock open in the mid 440s and close at 486.56. That is a massive green candle. But when you look at the actual headline numbers, it wasn't a straight flush beat, was it?
No, it was actually mixed if you only look at the surface. Revenue missed street estimates slightly. They came in at $211.6 million against an expectation of around $214.3. So a small miss on the top line, but they beat on EPS. GAAP earnings per share came in at $1.79 versus the street's $1.77.
So a top line miss, but a bottom line beat. Usually in a high growth tech stock, a revenue miss gets you punished severely. But here, the stock absolutely soars. Why the disconnect?
Because of the quality of that revenue. We have to talk about margins. Adjusted EBITDA margin hit 84%.
84%. Let's just pause on that for a second. That is obscene.
It is software level profitability on a hard asset business. Actually, it's better than most software companies.
Oh, way better.
Right. When you look at a typical SaaS company, they might have 70 or 80% gross margins, but after they pay for sales and marketing and all that overhead, their operating margins are much, much lower. TPL has virtually no cost of goods sold.
Because they own the land.
Exactly. They own the land. They don't pay to drill the wells. When you have 84% EBITDA margins, it means that for every dollar that comes in the door, very little is leaking out. It flows almost directly to the bottom line.
And that flow is massive. Free cash flow for the quarter was $118.9 million. For the full year of 2025, they generated nearly $500 million, $498 million in free cash flow. That is cash they can use for dividends, buybacks, or these new strategic investments we're going to talk about later.
And they are giving a big chunk of that back to us. The board hiked the quarterly dividend to 60 cents per share. That is a 12.5% increase quarter over quarter.
Which is a huge signal.
It signals incredible confidence. Management teams don't hike the payout by double digits if they see a cliff approaching in the next 6 months. It tells you they believe this cash flow floor is stable and, more importantly, rising.
Let's talk about the operational beats, because the revenue miss seems to be completely price-driven, commodity prices fluctuating rather than volume-driven.
Correct. And that is the key distinction for any commodities investor you need to understand. You can't control the price of West Texas Intermediate, but you can control your production. Oil prices were down significantly year over year, but TPL's production, the actual amount of oil and gas flowing out of the ground on their land, was up.
By how much?
Oil and gas royalty production hit 37.5 thousand barrels of oil equivalent per day. That is up 23% year over year if you exclude the acquisition they did back in November.
So they are pumping more oil. Even if the price of that oil is lower, that's pure organic growth.
Exactly. And the water side is even more impressive. Water sales smashed through a major psychological ceiling this quarter. They moved over 1.0 million barrels of water per day.
Wow.
Yeah. That is up 36% year over year. And produced water royalties, that's the dirty water coming back up that needs to be disposed of, were up 22%.
Okay, so the core business is humming along beautifully. But I want to dive into this counter-cyclical growth story. Because the CEO, Ty Glover, made a really interesting point about the macro environment on the call. He noted that oil dropped from $95 a barrel in 2022 to $65 a barrel in 2025.
Right.
That is a crash in anyone's book.
Yeah.
That's the kind of drop that usually kills the small drillers entirely.
It's a 30% haircut on the commodity price. In a normal cycle, you would absolutely expect activity to dry up.
Right. But in that exact same time frame, TPL delivered a 3-year compound annual growth rate of 17% in royalty production and 18% in water sales.
Yeah.
How is that possible? Everyone else in the patch is tightening their belts, rigs are dropping everywhere, but TPL is growing volumes at nearly 20%. What is the disconnect there?
It comes down entirely to the quality of their acreage. In a low-price environment, operators, the Exxons, the Chevrons, the Occidentals, they retreat to their best rock. They stop drilling the fringe acreage where the margins are thin because at $65 oil, those fringe wells just don't make money.
Makes sense.
So they focus all their capital on the core, Tier 1 acreage where the oil comes out easiest and cheapest. TPL owns the core. TPL owns the absolute best geology in the Delaware Basin.
So they benefit from the consolidation.
Exactly. As the industry consolidates activity, they are effectively consolidating it onto TPL's land. They are capturing market share of the drill bit, even as the total number of drill bits in the basin goes down.
That is such a crucial point. It's the flight to quality argument. The worse the macro gets, the more valuable TPL's land becomes relative to the rest of Texas. Now, speaking of drill bits and rigs, we need to get technical for a minute for this deep dive. The CFO, Chris Stasny, gave what I would frankly call a masterclass on Permian inventory dynamics during the call.
He really did.
He started talking about DUCs. And for you listening who aren't deep in the oil patch, let's clarify what we mean here. We are talking about DUCs, drilled but uncompleted wells.
Right. This is a crucial concept for understanding the near-term future of oil supply in the United States. A DUC is a well that has been drilled, the hole is in the ground, the pipe is set, but it hasn't been fracked yet. It hasn't been completed to actually start flowing oil.
So it's basically sitting there.
It's exactly like inventory sitting on a warehouse shelf.
Yeah.
The operator has spent millions of dollars drilling it, but they haven't spent the money to blast it with water and sand to get the cash flow going.
It's a sunk cost for the operator, basically. A stranded asset until they turn the valve.
Exactly. And over the last year, in 2025, the industry drew down about 600 of these DUCs. They were turning on wells faster than they were drilling new ones.
So they're eating into their savings account.
They are. And the bear case for the Permian for a while now has been that this savings account is running empty. If you run out of DUCs, you have to bring in more rigs to drill new holes just to maintain your production levels.
Which is expensive.
Very. Bringing in rigs costs a lot of money. If oil is at 65, operators might not want to spend that money, so production could theoretically crash. That's the big fear, that the Permian is about to just roll over.
But the CFO poured some serious cold water on that fear, didn't he? He came with the receipts on this call.
He did. He broke down the math specifically for the Permian Basin. He estimates there is still 3,500 to 4,000 DUCs remaining in the basin. Now, you can't drain that to zero. You need a buffer to keep your frac crews working efficiently.
Right, you can't have bottlenecks.
Exactly. You can't have a frac crew sitting around waiting for a rig to finish drilling. You need about 2,000 DUCs just to keep the logistics running smoothly.
Okay, so 4,000 total, minus 2,000 for the operational buffer.
Right. That leaves roughly 1,500 to 2,000 discretionary DUCs. These are wells that are fully prepped, sitting there waiting for a frac crew. At the current pace of completions, that is at least a year, maybe more, of clear runway.
So the industry can keep production flat or even growing for another 12 to 18 months without having to add a single new rig.
Precisely. And for TPL, that is the absolute sweet spot. TPL doesn't care about rigs. They care about completions.
Because that's when the oil flows.
Right. They get the royalty check when the well is completed and starts flowing. They don't care if the operator is stressing about rig counts or capital expenditure or logistics. TPL just cashes the check on the production. They are completely insulated from the rig count cycle because the operators are working through this massive backlog of inventory that sits right on TPL land.
It's a fascinating dynamic. The operators are stressed about macroeconomics, but the landlord is doing just fine. And there was another layer to this efficiency story that really stood out to me in the sources: the lateral lengths. I feel like every single year, the laterals get longer. It's like the TV screens in the 2000s, they just keep getting bigger and bigger.
It is the single biggest driver of U.S. oil productivity right now, full stop. The data points TPL shared were staggering. New permits on TPL land are averaging over 11,000 feet in lateral length.
Wow.
That means the horizontal part of the well goes for 2 miles underground.
And they mentioned somewhere over 20,000 feet, didn't they?
Yes. 34 wells permitted with greater than 20,000-foot laterals. That is almost 4 miles horizontal.
That's insane.
Think about the engineering feat there. You go down a mile, turn 90 degrees, and drill 4 miles sideways through a rock formation the width of a typical living room.
Just incredible.
But the implication for you as an investor is all about capital efficiency. If an operator can drill one well that is 20,000 feet long instead of 2 wells that are 10,000 feet long, they save money on the vertical section, they save money on the surface pad, and they save on all the surface infrastructure.
But TPL still gets the royalty on all the oil that comes out of that massive pipe.
Correct. It is operators doing more with less, and TPL is the pure beneficiary of that efficiency. They get the same volume or even more from fewer surface disturbances. It totally validates the quality of the contiguous acreage TPL owns.
Because you need the space.
Exactly. You can't drill a 4-mile lateral if you only own a patchwork quilt of land. You need long, uninterrupted corridors of acreage. TPL is one of the very few entities that has that massive checkerboard pattern that allows for these extreme wells.
It's an amazing setup. The operator spends the money to innovate, and TPL reaps the reward of the higher volume. It really is the ultimate business model. But, and here's the massive pivot for this deep dive, if TPL were just an oil and gas royalty company, the stock would probably be trading at a nice, steady multiple. It wouldn't be ripping 10% in a single day.
Definitely not.
The reason for the excitement, the reason we are doing this specific deep dive, is that TPL is changing. They aren't just selling oil rights anymore. They're selling capacity with a capital C.
This is the water power land thesis. And this is exactly why the valuation is starting to break away from traditional energy metrics entirely.
Let's unpack the Bolt Energy partnership, because this really feels like the moment where the narrative shifted from Permian landowner to pure AI infrastructure play. This was the star of the earnings call.
It's a very significant signal to the market. Bolt Energy is a relatively new player, but the backing is what really matters here. It is chaired by Eric Schmidt, the former CEO of Google.
That's huge.
You don't get a bigger name in tech infrastructure than that. This isn't some wildcat developer hoping to strike it rich in the desert. This is Silicon Valley royalty coming directly to West Texas.
And TPL isn't just leasing them land, right? They actually invested in this.
They did. TPL invested cash and provided land access. But the critical piece of the deal, the absolute ace in the hole, is the ROFR, the right of first refusal on providing water to any Bolt project.
Okay, explain why that matters for the listener. Why is the water right so important for a data center? I think most people assume data centers just need power and fiber.
Power is the fuel, but cooling is the limit. Data centers are incredibly thirsty, especially the new generation of AI clusters. You have rows and rows of GPUs running at absolute maximum capacity. They generate immense heat. If you don't cool them, they literally melt or they throttle down and become useless. There are basically 2 ways to cool them: air cooling, which uses giant fans, or water cooling. Air cooling is expensive and incredibly inefficient in the hot Texas sun, where ambient temperatures can hit 110 degrees in the summer. Water cooling is far more efficient, but obviously you need water.
And this is where the math gets absolutely wild. During the Q&A, someone brought up a shareholder thesis that Bolt's ambition isn't just a small server farm, They're talking about a 10-gigawatt campus.
10 gigawatts. Let's put that in perspective for a second. A typical nuclear reactor is about 1 gigawatt. A large coal plant might be 2 gigawatts. So we are talking about a single energy campus that consumes 5 to 10 times the power of a modern nuclear power plant. It is a staggering amount of energy.
And the water usage, I want you to run the numbers for us. I want to make sure the listener really understands the scale we're talking about here.
This was the aha moment for a lot of people listening to the call. If you look at the water intensity, you really have two buckets. First, power generation needs water. If they use natural gas turbines to create the power, they need cooling for the turbines. That's about 120,000 barrels of water per day per gigawatt.
Okay, 120 per gigawatt just for the power.
Right. Then the data center itself needs cooling, potentially another 200,000 barrels per day per gigawatt, depending on the exact technology they use.
So combined, you could be looking at over 300,000 barrels of water per day just for 1 gigawatt.
Potentially, yes. And if you multiply that by 10 gigawatts, you are talking about moving millions of barrels of water a day. The shareholder estimate mentioned in the Q&A suggested this could be $125 million in annual water revenue per gigawatt.
That is nearly pure profit revenue, too, given their margin structure. So if they hit 10 gigawatts, that is $1.25 billion in water revenue alone. That basically doubles the company's current revenue base just on water for one single client.
Exactly. Now, we need to be careful. Management didn't confirm the 10 gigawatt number explicitly on the call, but they didn't deny the scale either. They confirmed that the water intensity numbers are reasonable depending on the facility design, whether it's evaporative cooling or a closed-loop system. But the scale is undeniably massive. Even if it's only half that size, 5 gigawatts, it completely transforms the company.
And Ty Glover, the CEO, mentioned a distinct change in tone from these developers. He said, and I quote, "Urgency from developers has clearly increased."
That is a very key phrase. A few quarters ago, these were basically science projects. People saying, maybe we'll build a data center in West Texas someday. Now look at the macro landscape. The grid in Virginia, which is Data Center Alley, is completely full. It takes 7 years to get a new power connection there.
7 years.
Yeah, the grid in Silicon Valley is full. These hyperscalers need power, and they need it right now to win the AI arms race. West Texas has cheap natural gas, cheap solar, cheap wind, and massive amounts of open land. The only real bottleneck out there is water, and TPL owns the water.
It's the perfect choke point. They own the land for the plant, they have the gas to power the plant, and they have the water to cool the plant. It's basically a monopoly on physics in that specific region. You literally cannot build the future of AI out there without paying a toll to PPL.
It really is. And this leads us to the third leg of the stool, which is the innovation side, the desalination project. Because if you are going to use millions of barrels of water for cooling, you can't use fresh drinking water. There just isn't enough of it in the desert, and the local towns would riot. You have to use the brackish, dirty water from the oil fields.
Yeah, let's talk about Phase 2B. This is the R&D facility they have in Orla, Texas. They are building a 10,000 barrel per day plant using something called freeze desalination. Now, I'm not a chemist. Why freeze? Why not just boil it like everyone else does for desalination?
Boiling water thermal desalination takes a massive amount of energy. You have to put enough heat in to turn water into steam. Freezing it actually takes less energy because the latent heat of fusion is much lower than the latent heat of vaporization. Basically, when you freeze salt water, the ice crystals that form are pure water. The salt and the heavy metals get pushed out into the remaining brine. If you harvest that pure ice and melt it, you have fresh water.
Okay, so it's fundamentally more energy efficient.
Yeah.
But they announced a slight delay on the call, right?
Okay.
They said it's coming online in the coming months instead of right now.
Why?
The holdup.
They found a way to improve the process midstream. And this perfectly connects back to the data centers. They are spending $20 million to test what they call waste heat capture.
This is the synergy that absolutely blew my mind when I was prepping for this. Walk us through how a data center and a desalination plant work together. It honestly sounds like science fiction.
Okay, think about the two separate problems we have. Problem A, data centers generate massive amounts of waste heat that they desperately need to get rid of. It's a nuisance. It costs them millions to remove it. Problem B, desalination requires an energy input to run the thermodynamic cycle.
So you take the trash from the data center, the heat, and you use it as the fuel for the desalination plant.
Exactly. You use that low-grade waste heat to power parts of the desalination cycle, specifically helping to melt the ice efficiently. And then, and here's the absolute beauty of freeze technology, the output of the desalination plant is cold, fresh water, or at least very cool water. You then feed that chilled water directly back into the data center to cool the servers.
It's a closed loop. The data center powers the water plant, and the water plant cools the data center.
Robert Crane, their water EVP, pointed this out. This synergy brings the kilowatt hour per barrel cost down significantly. It makes desalination economically viable at a massive scale. And remember, the Permian produces 25 million barrels of dirty water a single day.
And they're running out of places to put it, right? I've read a ton about the earthquakes out there.
That's the macro driver for this whole project. You can't just inject this dirty water underground forever. It's literally causing seismic activity. Regulators are cracking down hard. The industry needs an exit valve for all this water. Desalination is the only long-term sustainable solution. If TPL corners the IP on freeze desalination powered by data center waste heat, they solve the oil industry's biggest waste problem while simultaneously enabling the biggest tech boom in history. They basically become the utility provider for the entire basin.
It's a total moonshot, but if it lands, the value creation is almost incalculable. And the best part is, they are doing all of this without betting the farm. Let's look at the financial guidance. They aren't spending billions on this yet.
Capital discipline is the watchword here. Their 2026 CapEx guidance is $65 million to $75 million.
That is tiny. They generated $500 million in free cash last year. They're spending, what, like 15% of their cash flow on total CapEx?
Precisely. They are not overspending on this transition at all. That $20 million is specifically earmarked for the waste heat equipment. It's a very measured, very calculated bet. They aren't burning cash to chase a dream. They are using a tiny fraction of their excess cash to build an option that could realistically be worth billions.
And the balance sheet.
Absolute fortress, zero debt, $145 million in cash on hand, and they just opened a new $500 million undrawn credit facility.
That's their war chest. Pure dry powder.
It is. It gives them the ability to jump on an acquisition if a neighboring landowner gets distressed, or to accelerate the Bolt project if it takes off faster than expected. They are in complete control of their destiny. They don't need to raise equity. They don't need to go to the bond market hat in hand. They fund their entire growth engine internally.
I want to briefly mention the rare earths thing before we get to the trade idea. It was a super quick comment in the Q&A about Hudspeth County.
Right. Hudspeth is out in the far west of Texas, not really in the core oil patch, but they mentioned that exploration for rare earth minerals there is, quote, promising.
It's just another lottery ticket, isn't it?
That's the entire TPL story in a nutshell. You buy it for the reliable oil royalties, you keep it for the massive water business, and you get these free call options. Solar, wind, data centers, rare earths, just thrown in for free. It is basically an index fund of everything valuable in Texas land. If the rare earths pan out, great. If not, the core thesis is completely intact.
Which perfectly brings us to the hold thesis. TPL is priced like a high-growth tech platform now. The multiples are definitely expanding.
Right.
But it pays you like a mature energy company with a growing dividend and share buybacks.
It is the ultimate inflation hedge for a portfolio. You own the land, you own the water, you own the oil. And now you own the gateway to AI power generation. There is very little else in the public market that gives you that specific weird mix of hard asset protection and exponential tech upside.
So what does this all mean for your portfolio? We've looked at the numbers, we've looked at the tech, we've looked at the rocks underground. Now it's time for the part of the deep dive where we take off the analyst hats and put on the trader jackets.
The fun part.
This is not financial advice. We have to say it. We are not your financial advisors. We are just two voices in your headphones trying to make sense of the madness of these markets. Do your own due diligence. But if we were pitching this to an investment committee today, here is the trade. I call it the West Texas Wet Compute ARB.
Okay, I like the name. Lay it out.
Here is the setup. NVIDIA chips are completely useless without electrons. We know this. Electrons in West Texas, where the wind blows and the sun shines constantly, are cheap, but they are useless to a data center without cooling. Cooling strictly requires water. TPL owns the water and the land for the power plant.
The ultimate choke point.
The trade is this. Long TPL. You are effectively making them the landlord of the AI revolution. But to hedge it and to fund the position, you join it. Short traditional utility ETFs, something like XLU.
Interesting. So long the unregulated infrastructure, short the heavily regulated utilities.
Exactly. Think about it. Traditional utilities are regulated. They are slow. They have massive, heavy capital requirements. Their return on equity is strictly capped by the government. If they want to build a new transmission line to feed a data center, it takes 10 years of environmental permitting. TPL, they are unregulated. They have 84% margins. They own the land fee simple. They charge a toll on the AI infrastructure build-out, and they do not have to ask a public utility commission for permission to raise their prices.
You are effectively buying a water and land REIT that prints oil money to fund its own tech expansion, and you are shorting the slow-moving incumbents who simply can't keep up with this new demand.
And the catalyst for the trade is the announcement. The moment we get a press release saying Bolt Energy breaks ground on 1 gigawatt facility on TPL land, the stock re-rates again.
And the risk to the trade.
If it doesn't rain, TPL still has the massive underground aquifer. If AI is a massive bubble and goes to zero tomorrow, they still have the oil royalties paying them millions. It is a heads I win, tails I don't lose much kind of trade.
It's compelling. You are essentially betting on physics and geography over regulation and bureaucracy.
That is the bet. So, to recap our deep dive, strong beat on the bottom line, record water volumes breaking the 1 million barrel mark, massive undeniable progress on the data center and power strategy. The stock is up 10% because the market is finally starting to believe the hype.
The transition from a sleepy energy company to a dynamic infrastructure platform is happening right now, and the Q4 numbers completely confirm it. Oh, and here's a final provocative thought for you to chew on. If TPL perfects this closed-loop data center cooling and desalination system, they don't just have to use it on their own land. They could theoretically license that intellectual property globally to any desert region trying to build AI infrastructure. Saudi Arabia, the UAE, Arizona, the IP alone could eventually be worth more than the oil.
Now, that is a wild thought to end on, licensing the IP globally. Also, a quick reminder for the diehards out there. There is a shareholder event coming up, May 18th in Midland, Texas. It's an office and water field visit.
If you really want to see the Freeze technology in person, that might be your chance to see it up close.
Get your boots dirty. Well, thanks for listening to Talk Tickers. Keep your stops tight and your thesis tighter. Again, this is not financial advice. Good luck in the markets.
Good luck.